All right, I think we are streaming now. Let me check, make sure everything's working. Looks like we are live. Okay, cool. So I want to recap a little bit from a couple weeks ago. Let's go to, actually, let's look at the VIX also before we go into the trades. Not normally this low. Let's get a little closer to. Forgot to get my mouse set up. You probably hear a lot of clicking. Let's see. I mean, this is fine. So when was I live last? What day was it? Let me check that real quick. It was 2 weeks ago. It doesn't tell me the day here. The 14th. Yeah, so it was when it was here. When VIX was spiking up into 22, up into the green zone. And then we had a few more days, spiked up, reaching up to what, almost 28. You can see here. The high was 28.27. I need to turn off my notifications. I'll gotta remember to do that in the future. Yeah, so 28.27. Actually, that would show me the same thing too, like 28.27. And that was the peak. Really big day here because it opened down here around 17 and went all the way up to 27, and that was the top. And now it's gone down 1, 2, 3, 4, 5, 6, 7, 8 days in a row. Looks like it's actually up a little bit today, but well, it was up a little bit here too. But red candle. So my last stream was here. You had 1, 2, 3, 4, 5, 6 days to get into those trades, and you would have been able to either do it better than what I had or about the same. But now volatility is all the way back down under 17, which is what it does every time. You know, it spikes up and drops back down. So let's see some of those trades. Now I know I can remember it's now 57 days. They were close to 90 days, 85 days. And actually, let's look at the chart real quick. On the 14th, it was the second day it started dropping. So the high was around 6,800 and we are at 6,857. So the market's a little bit higher than it was, but it's pretty close to the same place. So the market's up 50 points from where it was at the high on that day, but volatility is way lower. It was on that day it was up to 22 and now it's down to 15 and the market's almost in the same place. So this is why I don't trade price as much. I trade volatility and I trade time because time's always going to go by, and most of the time volatility is going to be decreasing compared to increasing. Most of the time it's going to actually stay the same, but it decreases more than it increases. So let's look at the trade. It was shorting the 6,600, which was like a 40 delta, 45 delta. Now it's a 24 delta. Something like, I think it was around that. It was the 63 and the 61 for the spread, and this was get back to, hold on, I'm gonna open my stream to make sure I can communicate with the chat. So that was the spread, and I was looking at 3 of them. Now this, I don't recommend doing this large of a trade right away, but this is just something that I noticed that I was looking at. And then this was 4 contracts at the 5,500, and this was trading for 215. So if we go 215 minus 75, that's 140, and everything in MES is times 5. So that's a $700 profit on this trade. And I recommended using around $10,000 or having a $10,000 account to put this on. Now, and the buying power was around 3,500. Now the buying power is 2,800, and you have a $700 profit. Using $10,000, a $700 profit is 7, right? So in 3 weeks, you would have made 7% on this trade. And then the rest of the buying power you put into SGov, and you get about 4% annualized on that. So that would have given you a little bit of free cash as well. So great trade. There was, let me see, I probably should have had them lined up what else I was looking at. I don't remember the other strikes. I did another stream. Probably looked at a couple of 111s there. Okay, so here's another one. I was looking at a 111 if you were just starting out, 6650. I'm pretty sure it's the same time frame. No, it was the end of the year. December 31st. No, actually it wasn't. It was January 30th. Okay, well, let me go here. January 30th, which is only 57 days now. I was looking at this. It was looks like 77 days, and now it's 57 days. So it was, maybe that's a 2. It's hard to see what the DTE is. Let's see. It was, no, this was on the 14th. I don't know what I'm talking about there. Yeah, so this was about 3 weeks ago. A 111, 6650 was the put that you would want to buy. The 6250. This was a really large 111, $400 wide spread, and then the 5750. Very cheap to put on. It was trading for, what was it trading for? And then I was adding another put on there around at the money, which was like 6,700. 67.25. And then this was trading for 160. And now it's only trading for around 60. So that's a huge profit there as well. About $500 profit, and you're only trading 2 contracts. So I'd recommend starting with 5,000, 6,000 for that. So if you're making a $500 profit on $5,000, that's around 10% right there. And with the market dropping like it was, you should be in a couple of contracts, a couple of tranches, scaling for whatever your account size is. Obviously, smaller accounts you're just doing one contract, but larger accounts you can do multiple. Dogs are playing outside. So at this point, you want to peel some of those off, um, or roll some things up. You might be in a good position to keep that 111 on, kind of as a hedge. I forget what it was. Let me see what's the. Let's check that again. 66.50. Yeah. So if you do have something, roll at 50s like this. So if you do have something like this on, it's only using $200 in buying power, and you have that max profit of 1,800. It's pretty close to what it was trading for. It's a little bit cheaper, but you're buying these 111 huge 111s as a hedge. You're not really this isn't where you're making all your money from. So this is what's hedging against the other short put that you want to have kind of close to the money. So we'll go right back to it here. So it was like 160. This is what it looked like. And now it's only trading for 62. So now that you've made all that money, this is basically what you're left with. You can leave this on because this is going to be your hedge against the short put, and you want to roll the short put up and collect more of a credit. So you can probably go all the way to the 6,900 and be left with something like this now. So your risk is only maybe 1,000, and now you're adding another $500 credit on top of the $500 you made. So it's pretty interesting. You could also just, if you don't want to hold that risk, if you don't want to have the 2 tranches on, you know, if the market freaks out and drops down here, you're going to lose a couple thousand. But you can take the whole thing off and put a 111 on, go out a little farther, and do the same thing where you start at the money with the buying put here, go out like 300, 250. How's she doing?
She's good.
Good.
Still the same. She's doing a little thing at night, but good.
Yeah. So that you have to pay about 70 for that. You can go out here and sell something to kind of cover that. Let's see.
Yeah.
Can't get very far. I would like to sell something down here, so maybe just do $200 wide, and then you can sell something down here for around 50, 53, and you pay a small debit. So now you're restarting this. You can have a pretty large hump here. You have no risk to the upside except for what you pay, which is just like $30. As time goes on, see that it kind of starts like a strangle with no risk to the upside. And as time goes on, your break even moves down lower. You're going to make the most money around your put spread. So as the market recovers from what happened a few weeks ago, it's probably going to stay around here a little bit more. It might keep grinding to the upside, so you'll make a little bit. And if it does start to freak out and come back down, it's gonna settle down in your trap somewhere, and then you can just sell another put kind of at the money. And then you'll get a huge credit when you do that, and you'll make a lot if it rebounds back up. But right now you want to be kind of small. Like it looks like the market actually went up today now. It was down a little bit because VIX was increasing, but see, look, VIX is now down even, which is kind of funny. So we had these multiple up days, up 100, up 100, up 100 from the low to the high. I mean, this was a lot on the first day. And then obviously VIX is going to be getting crushed those days, so you're going to have less expected move. So then it only goes up like 60, 50, 40, 30. And then once we get back here, VIX normalized around 18, 17, then it's just going to be choppy. That's normally what happens. It chops and grinds up higher. So that's kind of what I'm expecting now is a little bit of a chop in each day, down a little, up a little, down a little, up a little, but probably still going to have more up days than down days. Because these down days, they always cluster together. That's what I was saying here the other day. They cluster together. I thought maybe it would turn around here because you have this kind of candle, but that doesn't ever mean anything really. There was 4 more big down days or 3 more big down days and a little pause here. But that's kind of what you get. You'll get a cluster of multiple down days and then a rebound, multiple down days, and then a rebound, and then it'll grind up higher, kind of like here. Just kind of grinds up. So you can see volatility is stretching to the downside. So that's when you have the most risk for it to fall. Again, it's not the price falling that's gonna really kill you, it's the volatility increasing. So that's why you want to have less contracts. So in the orange zone, I normally just have one contract one short put in the red zone is normally when I do the 111s where you have negative delta, because that's the danger zone. The market's probably, if it is going to keep grinding up higher, it's not going to be going up that much every day. It's just going to be a little bit, and that's when all the risk is in volatility increasing, and the market's going to drop at some point. But when it's in the orange zone, it could keep just grinding up. But obviously, the risk is it popping back up again. You're going to lose a lot if you have a lot of contracts on, so you want to kind of stay away from that. And then the yellow and the green, that's when you want to start scaling everything up. So yeah, if you got short volatility any of these days, even when it started coming back down, anywhere in the yellow, you start shorting volatility, you'd be great right now. So let's go back here. And you can do, as it's moving from that orange zone down to the red zone, it doesn't get down to the red zone very often. It'll normally stay in the orange zone, but you can go out farther. That was just looking here. You can put the 111 on at the money, but you can't do it very wide. Like I only had a $200 wide spread. If you go a little bit further away, like a 30 delta, you buy the 30 delta, you sell a 20 delta, or like a 16 delta, you go $300 wide. Then you can sell something down here like a 10 delta. And you're paying about what I was saying earlier. You're paying about the same as the other spread, but you have a wider trap. I hate how this is always zoomed in so much. I wish it actually zoomed out more. But same thing, you don't make anything to the upside. Well, you make a little bit if it stays kind of where it's at. But you have a little bit of risk to the upside. It's just what you pay. It's $45. But you have this huge hump down here. And this is in a little bit too, so. Your P&L at expiration is almost $1,500 here when you have something like this. It's 300 times 5 minus your debit. If you do put another short put on, like let's say the market starts falling, volatility starts increasing, you sell put at the money, it's going to be probably around $200. You start to get this like stair step. It saves your P&L here. Instead of just putting on the short put, we can turn them off here. Turn off the 111. This is kind of what you would have if you just had it, what it would look like if you just had one short put. It just falls off pretty quickly, right? You're losing $1,000 here, just a couple hundred points below your put. But if you have the 111 on, there it goes. Okay, so we should be back on. Let me just wait to check. Okay, cool. Yeah, so that's when the magic happens, right? When as time goes on and you have the bear trap on, it's gonna move that break even down. So if you just had the short put on, that doesn't really happen as much. See, that's the difference. You're still kind of losing money in here, but that 111, you actually make a decent amount here, and it moves your break even down. And then you can scale up on the 111 also, if that's what you want to do, or put another one on lower. But I can't show that. I wish I could show that on Tasty and add like 8 legs and analyze that all at once, but it doesn't let you do that. But adding another tranche of the 111 on here, so it's like a 222, kind of shows you the same thing. So then you get that spike, the peak and the mountain in the valley. It's kind of cool. So your break even drops way down. Did you see that? It was like here, it drops way down here. And it adds, you'll actually be able to sell that instead of buying it. So your credit would probably be closer to like 200. So it would look more like this, which is pretty awesome. I have 3 short puts that aren't covered, 3 naked puts. You got 2 down here and 1 here, which would kind of be at the money or in the money a little bit. That's when you really make a lot of money, because you make $1,000 basically. I mean, look at the theoretical. This is $1,000 right here, and it stays pretty flat even into your put spread. And so you want to be able to hold this. You don't want the market to come down here and then you get margin called and you have to close it for a loss. You want to be able to hold it. So if it does come down here, you can hold it in time for it to rally. And you want to be able to add on to it as well, because if it drops down here and then it starts dropping down here even farther, you want to be able to put another 111 on down here to move your break even down even farther. So like I said, I can't really show that on Tasty unless you could add more legs, which would be cool. Maybe they'll do that in the future. But as time goes on, see the break even just drops so much, and your line is just almost straight across all the way down here. You know, this is $1,000 right there, $1,000 profit. And the difference in a trade that grows into something like this compared to your just one short put here. Let me take them off. That's the difference. The market drops down here, you're losing $1,000 with the one put. If the market drops down here and you have something like this kind of covering it, you're making $1,000. And if it drops down here and just goes back up, you still make $1,000. So with the 3 short puts, you want to have maybe $7,500 to $10,000, but you're making 10%. You're making 10% even if the market drops 500 points in 2 months. I don't normally hold this all the way to the end, but that's where I was showing, and just jump ahead. And volatility would probably increase some. If it's down here, volatility is going to increase. So it will take away some of your profits, but we can show that here too. Let's say it goes up to like 25, 26, I mean even up to 30. If you hold it a little bit longer in the trade, you get the same outcome. Hold it into February, a couple weeks into February, you're still making $1,000 all the way down at 6,400, which is 450 points away from where it is now. And you're only in 3 contracts, 3 tranches, whatever you're trading. And at that point you can I mean, that kind of makes it look bad. But you can add another, well, it changed the credit too. If the market drops down here and you want to sell something, another put out here, you would be adding another maybe 60 credit. So it would actually be something like 260. So you could add something like that. You're adding to your tail. At that point, if the market drops, you know, $400, $500, even $800, it's going to rebound at some point, you know. That's why you want to be able to hold all these. Excuse me. But that's like one of the worst case scenarios, right? If the market drops 800 points, 850 points from where it is now in the next 2.5 months, you're only going to be losing, you'll be losing $1,000, which is a very small chance of that happening. The way this is set up now, you have a 94% probability of making money, which is amazing. If you lower that back down, and that's just one of them, you give up your profit there. But two short puts and two contracts on your spread, you can do this with $5,000-$6,000. You're still making $400-$500, which is 10%. So I really like the way that this sets up. When you have a mountain here and a little valley, and then your tail, you have that 1-1-1, and then you sell something at the money. You need to get a good credit to build that tail up, because most of the time when you do these 1-1-1s, most of the time the market ends up at your tail anyway, because the market just grinds up higher. But in the chance that it does drop down here, you're kind of covered. Jenny wants to come in. Let me let her in. Daphne came in too. Guys, these are the good ones. These are the good ones. She's so loud. You're the good dogs. Mary, wanna say hi? Look at this pretty girl. Don't lick me. Nova changed colors. Just kidding. Oh, that's Jenny. Hi, Daph. Oh, this is Daphne. Ugh. The Good Shepherd. They're best friends now. So yeah, you make money when the market's kind of falling and rebounds. So right now, after the rebound, where it's just probably gonna float around up here for a while, probably grind up a little bit higher. It's gonna most of the time it stays inside the expected moves, which is actually half of the green. The green is a full standard deviation. The expected move is normally about a half standard deviation, so after it rallies, it's probably going to stay, grind up in here somewhere. If it does drop down, the risk is normally in between the blue and the green. And then when that happens, that's when you start scaling up. But it's a good time to just have one contract anywhere from like the 35 to at the money, depending on your risk tolerance. You can just do one of these and just hold it. So if it does go in the money, you know, you have 3,500 buying power to cover it. 38, 4,000. So you don't want to get margin called, so you want to be able to hold it if the market drops. But then you'll actually make some money if it keeps going up. So that's kind of what I do. You got to put it on for $2,500, and then if you have $4,000 per contract that you have that you're setting aside, you can take that other 1,500 and put it into SGov. That's one of the best ones right now. You can see there's no risk or anything here. I have a little bit in there from something else. Just paid out 3.74. It's the same as Treasury bills. See, that's what it is. 0 to 3 months. But there's no risk. See, it just goes up a little bit every day, and then you get the payout. It goes up a little bit every day, and then you get the payout. Risk-free. So you put the extra money in there, and as the market just grinds up higher, you can buy more. If it drops down, then you just sell it so that you can hold your options. That way you don't have to, you're not picking stocks, you're not trading the price, you're just trading volatility and time. But now the market's down a little bit. Let's look at it on a 1 minute chart, see what it's actually doing today. It's a big red candle. It dropped a little this morning. That's when volatility was up. But it's not going to go anywhere, I don't think. When the market drops, it'll normally give you a sign first. I normally look at 3 months, 3 months in daily candles. So you'll get a day, a red day with volatility increasing, and maybe it goes down to the expected move, maybe a little bit past the expected move, which is just $20. So maybe it goes down 30 or 40 today. That would be a sign that it might go down more tomorrow. But it's not going to go crazy. Volatility is only at 16.5. You see, it'll build up a little bit and then it spikes up. You'll normally get a little bit of a sign. They're so cute. Jenny's so loud. She likes to talk a lot. Don't you, Jenny? Don't you, Jenny? I'm gonna get you. She's such a little dog with the big fluffy tail. She's smaller than Nova, and she's got a fluffier tail. But Nova's tail curls all the way in a circle, and the tip of her tail is pointing back out. It's so funny. I noticed it earlier. So yeah, you just want to be careful. Now you want to be kind of light on your positions now that we're back into this orange zone. Wait for it to get up into the yellow zone to add more. And it's a good time to roll things out a little bit farther. And I've looked at going out really far in time, like 120 days. Instead of 90 days, I like to start the trades around 90 days. So I would be looking at putting something in at 85 days. Closing what we had before, it would be 57 days now. I closed that and roll it out to 85, but sometimes you can go out a little bit farther. Maybe 134, we can look at it. Buy something here. Let's see how wide we can make this. See if we can do a $400 wide. Something like this. You only have to put up less than $300. I gotta zoom this out again. I wish it just stayed zoomed out. But now it's really hard to see. And here's your 2 standard deviation. So less than 5% of the time, it'll actually get down here. So you barely, that's why you only have to put up $300, because that's kind of your risk on the trade. But if it drops in here, you can make almost $2,000 if you hold it to expiration, which is wild. But yeah, you put up $300 and you can make $300 if it stays around here, 6,700. If it drops a little bit. So these are really interesting as well. Let's just jump ahead a month at a time. And add, well, we can add 10 here. Same thing if it goes up to 30. Which, if volatility goes from 20 to 30, it's probably, the market probably dropped a couple hundred points. So it would probably be inside your put spread. You know, in a month, let's say it drops a couple hundred points in a month, it would be in your put spread. You'd be making $500 off of, it might increase to $500 or a little bit more. Might increase $500 or $1,000, but you're making $500 off of that. So I really like the way these set up too. And then same thing, you just kind of sell a put that's kind of at the money, close to it. And if it goes back up, then you make a lot off of it. So I think there's a couple people here. You guys have any questions? Damn, why did it disconnect again? I just got this new internet not too long ago, and it does not work as well as I would like. But it looks like there's a few people in here. Do you guys have any questions in the chat? I can see your comments or your questions if you want to chat. But I'm probably just going to wrap this up for now. I hear Nova out there barking now too. She wants to come in. She went away. Guys, I just cleaned the floor. Now it's all muddy in here again. It was so wet the other day because of the snow. Rain, it was like snow rain mix. They got the whole floor was just covered in mud. And I got it all cleaned up yesterday, and now it was really cold this morning, so everything was frozen. So they weren't tracking any mud in, and now it's getting a little bit warmer and everything is unfreezing, thawing back out. Hi, Daff. Come here. She knows not to jump on me. Can't show her. I can do this. Hi, Daphne. Oh, you're so cute. I think you can see her. Just her nose. But yeah, you guys got any questions or anything? Am I just not seeing the messages, or is nobody messaging? She loves ear rubs. Hi. Hi, cutie. Good girl. Actually, let's go back and look at the chart. So something else I was talking about back here was the one-to-one trade where you just sell at the money puts. You can do it super small. That I'd recommend doing in SPX. Um, but you try to catch the bottom of these moves. So I don't know if I don't know what if you try to start it any of these days here. Let's just say you start it. Just say you start it here. Maybe here. Let's say you get this green candle and you think it's just going to go back up. So you start it here, you sell that one-to-one trade for the next day, you would lose. Then maybe, honestly, I probably wouldn't do it the next day. But you get this candle, maybe you do it for the next day. When it goes up here, you could probably take that off for a winner. So let's say you lose one day, you win one day, you put it on again. You probably could also close that for a winner when it was up a lot. If you wait till the end of the day, honestly, if you closed it up here and then it came down here, I don't know if I would put it on again. Based on the volatility though, that was the spike in volatility. So if you did catch it at the end of the day and put another one on, that would have been a winner. Put it on the next day, that would have been a winner. Put it on the next day, that would have been a winner. Put it on the next day, that would have been a winner. Put it on the next day, that would have been a winner. At that time, I probably would. I mean, this is when I said it's probably just going to trade in a range for a while. So iron flies is what I like to do on days, after it gets back to where it was. You do iron flies, iron condors. You try to just keep, it's probably going to stay inside of its expected move. And I mean, that's what it did almost for the last 4 days. So if you did start, you started here, you lose one, you win two. Let's just say you lost again. So you're back down to one, but then you win 1, 2, 3, 4 in a row. You're up like 400%. You make 100%. Either you make 100% or you lose 100%. Or, sometimes close it early so you make, let's say, 90%. But if you can start sometime, if you try to catch the bottom somewhere in here. Hey. You try to catch the bottom somewhere in here, and then you make 100% every day when the market's going up. You only need it to go up like, depending on volatility, you only need it to go up like 15, 20 points, and you're going to make 100%. So if you think it's going to keep just grinding up from here, it might be a good time to put one on now. But you just I'll show you how it sets up. You go to 1 day, go a little bit in the money, and you sell a put spread. So this one's a little bit less. It's $5 wide. You're risking, you want to be at 250 for 250. So maybe you go up one here. You sell this for 250, 255. You need the market to go up 12.5 points. If it goes up 15 points tomorrow and closes, you make 100%. So obviously you don't want to do this with your whole account, but you can do this with like a percentage of your account, and like not 1%, but figure out your risk. Maybe 5%, maybe 10% of your account. If it's not an account that you need to save that money. If you're trying to take, you want to take risk. If you're trying to conserve your money, maybe it is 1% of your account you do this with. Whatever your account size is, you can widen it out. I don't know if I would do a whole bunch of contracts, but you can widen it out and do the same kind of thing. So, like 750, 750. 1,000 for 1,000. And it only has to go up, like I was saying, 15 points. So it's kind of it's an interesting trade. If you can catch the bottom, like I was saying, if the market goes down 5 days in a row, it's probably not going to keep going down. So you put something like this on. I mean, if it does go down, you lose everything in that trade, but if it goes up, you double your money. And the market, you get those V bottoms. So if you can catch it somewhere close to the bottom and you make 100% multiple days in a row, even if it's a small percentage of your account, you know, a couple 100% on a small percentage of your account, it's actually a pretty decent return. What would you say is the recommended dollar amount per trade? On a trade like this, the 1-to-1 trade, around 50%. 50% the spread. So if it's a $10 wide spread, you want to collect around $5. If it's a $5 spread, you want to collect around $2.50. So it looks like the market's already jumping up a little bit. It was just down 7, now it's down 3. But, you know, if it's a $15 wide, you want to collect around $7.50. $20 wide, collect around 10. On this kind of trade, the 1-for-1 trade, you don't protect it. You protect it by only using a fraction of your account. So you only risk what you're willing to lose. And try to not do this trade when the market's falling, because like I said, those big red days normally cluster together. So just when we get a couple of red days where it's outside the expected move, it's normally going to happen over and over and over again. So just don't trade those days, and then when it starts turning green, then you put it on and you can do it day after day. But that's the best way to protect from a black swan event. It's just keeping your size small. But for the bear traps, it's the same thing. Basically, you watch VIX. So this is what will protect you in the black swan events, is scaling properly in these different ranges. When VIX is up here in the green zone, you're going to be getting paid so much for the naked options that if it does go up higher, it's not going to hurt you as much as if it's down here. So if it's in the red zone or the orange zone, you're not getting paid for the options you're selling. So the risk is when you're selling options and it's down here and then it shoots up here. That's when everybody blows their accounts up, because they trade too big down here because they're not getting paid. They're not making as much money, so they think that they can do, you know, more contracts to make up for the money that they're not getting from selling the options. And then when volatility goes from 15 to 30, their accounts blow up. So that's what I do to protect my account, is scale everything down. As VIX is coming down, you scale everything down. So in here you should only have like one tranche on. In the red zone, a lot of times I'm delta neutral or even short. Sometimes I'll hold some short deltas. And then in the yellow and in the green, then I start to get long. So if it's in the orange zone, you might not want to do the 1-to-1 trades, the ratio trades, or like the put spreads, because we have risk of multiple down days in a row. So that's you know, when you get these spikes in VIX, it's probably going to continue for a little bit more, just a couple of days. It's not going to continue indefinitely though. So you wait that out. You sell puts, and then you do the 1-1-1 trade. When we're in the yellow or in the green, you can start doing that 1-to-1 trade. That's what I recommend. But we might chop around, like the volatility might stay around here for a while, and volatility can stay here in the orange zone, and the price of S&Ps will go up. So that happens a lot. Like in here, we can look back. What was this, September 14th to for a month? We can go back and look at that. So September out a month. It looks like let's see what the prices were here. 66.50, and then here it's like 6,800. So it went up. Price went up a couple hundred points, 150 points. See, the price goes up, but in VIX it stays about the same. Like from this day to this day, it's literally the same price. And in MES, it's from like this day to this day, it went up, you know, 150 points. So the price will go up when VIX will stay the same, and price will go up. And then when it drops, when the price drops fast, that's when VIX spikes up. So those are good questions. But you can do the 1-1 trade when we get price action like this. It'll work a lot of the time, but if it doesn't really move that much, like in these small days, you might lose just because it doesn't go up that much. Like this day, like you put it on here and it doesn't move enough the next day. So the best time to do it is obviously when we get days like this. Days like this, boom, 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 boom. You know, if you put it on here and it goes up and you don't close it, it comes back down. It might be like right at your short. Probably would win that day. You know, you might win that day. But this one it didn't move enough. This one it didn't move enough. So you could lose on a couple of those days. Then maybe you win on that day, you lose on the next day. Then maybe you don't trade for a couple of days. I don't know if you would catch it here. Maybe you start here and you put it on the next day and you lose that day. Put it on the next day. Probably would close that early, I would recommend, but you know, maybe you put another one on, it goes down the next day. So it's a lot of times you'll win one, you'll lose one, you'll win one, you'll lose one. So you're not really gonna doing the 1-to-1 trade, you're not gonna lose a lot unless you're putting it on those down days. If you get caught in one of these clusters where you put it on, you lose, you put it on, you lose, you put it on, you lose. You just have to avoid that. If you can avoid when the down moves cluster together, and then you can just kind of catch it on the rebounds, you end up making a shitload of money. But you got to watch those trades. You got to watch the market every day, kind of thing. They're more stressful. So when I like to trade with as little stress as possible, and not really watching it, like 15 to 20 minutes a month. You can do the 1-1-1 trades, and you barely have to watch anything. So that's my go-to. Closer to the money, you want to do them a little bit smaller. Just go to even numbers. So like 68, 66.50. Sell or buy this for 40 and then sell something for 40, or even a little bit more. You can get a small credit. Max profit 800. You only have to put up 800. So I really like these trades. You can set them and forget them, and then you just adjust as time goes on. But you make a little bit to the upside. You make a lot if it falls a little. The only way you lose is a black swan event like you're talking about. But if you just have one on, you hold it. Your naked put is here, so you just hold this. And you scale up. You put another one on down here, so then it moves your break even down. And the market's not gonna drop all the way down here. Without you having time to do something about it. And then in that case, if it does start dropping down here, you're scaling up, you have other naked puts around here, you can take this one and you can roll it out and roll it down. So you'll end up moving this down anyway. So that'll move your break even down. You put another one here, it'll smooth it out. So you might not make any money, but you might not lose any money. But you can end up moving your break even down. If you scale in properly, you can move your break even down 20-30% below where the market is, and then you're pretty much good. I mean, some of the worst times in the market, it only went down 30, 40, 50%, I think, in a year. It's only happened like once. And then that's the best time to buy it if everything's cut in half, everything's on sale. Most people, they don't have any extra capital on the side to take advantage of that, so that's why you want to scale properly. Another thing you can do, if your deltas get too high, if you're all in and your deltas are too high and the market's still falling, you can short the future. You just sell the future. Just click that. Short a future. It gives you, it's like minus 50 deltas, I think. So if your deltas get too large, I have a tracker sheet also. You can put in your amount of your net lick for your entire account, and it'll basically tell you what your deltas should be, what your theta should be. So you can keep everything in line, and you can use the tracker sheet. It'll show you if things are getting out of line. You can short the futures. You can do that for free normally when you have, if you have enough puts on already. When you short the future, it'll actually give you buying power back. It won't cost you anything. It'll actually give you money to short the future because you're taking away a lot of your risk. So you don't have to use any extra capital. It'll save you from getting margin called. That's like the last resort option, is just short the future. The problem with that is if the market turns around and goes up, you're not going to make the money that you would like to from your shorts. It just stops everything. It's basically, instead of getting margin called, short the future, and it takes your risk away, but it'll also take your profit away if it turns around the other way. So you don't want to hold the short futures very long. It's only like a last case scenario. But don't ever close the short puts in the money. If you're selling them out of the money and they go in the money, you have to be able to hold it. If you close them for a loss, you're going to lose money. If you short the futures, it saves you. For the 1-1-1 trades, the bear traps, do you have a specific duration for the trade, and also when to close out of the trade before expiration? It depends where the market goes. But yes, I like to start them around 90 days. So if I'm putting one on now, I would go somewhere between 90 days and 120 days. So you could do 85 days, you could go all the way out to 134. So I was looking at them a little bit earlier, but somewhere in there. It depends. So basically you can decide how much money you want to make in whatever time frame you want to make it. So I like to do 90 days because that's a quarter, and I try to target 2% a month. So in 90 days you want to make like 60%. I mean 6%, sorry. And there's always a better opportunity to sell puts. So you want to wait until you just sell naked puts outright. But if I was just starting, if I had nothing on, I was just starting right now, I would probably go out 85 days here, and I would possibly do something like this. You're not going to make that much right now off of it. You can start building the trap here. $200 wide times 5 is 1,000, so your trap is $1,000 wide. You have a small tail, so you want to have like $3,000 to $4,000 available for this trade. And let's see, we can jump. It is already at the end of January. So this is like 2 months. If the market falls a little bit, you'd be making what you want off of it. The only way you don't make as much is if it just keeps grinding up. But if the market drops a little bit, and you can sell a put at the money, or a little bit outside of the money. Or you can start with something like this if you want to just sell two contracts, 2 naked puts. You want to have $7,000 to $8,000 in your account to do this, to do 2 tranches. But if the market just grinds up higher, you're going to make $600-700. So $700 in a $7,000 account is 10% in a couple of months. But it's all about timing it. You want to make sure you time things properly. You want to take advantage when volatility pops up. That's when you're really going to make the most money. So I mean, you can just sell a put out here if you want to, something around the expected move, 25 deltas. You could just sell this for now and wait. $4,000. You'll make 400 bucks if it goes up a little bit. You'll start to lose if it drops, and then you can put a 111 on and move your break even way down. So maybe do something like that. Start with the short put now. Just sell one short put for every like $4,000 you have. You can kind of, you want to be somewhere around here. If you're just starting out, somewhere between like 20 deltas and 30 deltas is a good starting point. I like 25 deltas is like the optimal place. And you just hold it. You hold it until there's not much left. So maybe you hold it till it's like 85%, 90% profit on the shorts, and then you close them. You close them, and you put a new trade on. Or you take that money and put it into SGov, depending on where VIX is. So it always depends where you are on VIX here, what area you're in. But right now I would only have kind of one tranche on, if that makes sense. Maybe one short put, and you could do one bear trap, or just a naked short put. You can wait until, if it gets in the red zone, when it gets in the red zone, you should probably just have one bear trap on. And when it's in the orange zone, you can just do the one short put. If you have a bear trap on from before, then you can still hold that. So in the orange zone, it's okay to have two tranches, but I wouldn't have two naked puts alone, if that makes sense. But you could go out farther to do a bear trap. Wonder if I can put them on at the same time, just to show. I was showing this earlier. You could do $300 wide. You can do something like this where you're almost, it's even, so you're not paying anything for it. You're not going to make anything to the upside. But this can kind of be your hedge. You almost want the market to drop down to like 6,000. So the market drops down here, then you sell another put. I wonder if I can do this and then also show this. Yeah, so here you get that stair step. So if the market does drop, I'd have, you almost get something like this. But you're gonna get, if the market drops down here and then you sell this other put, it's gonna be a way higher credit than this. It's gonna probably be between 150 and 200. So, I mean, let's just say it's 150. It would look like this. So you at that point you only have two tranches on, which would be maybe $8,000, $7,000, $8,000, and you can make over $1,000 off of that, which is over 10%. And you're probably going to do that. That would be like 4 months. 10% in 4 months. That's about 2.5% a month. So that's a little bit above target. And you'll make that anywhere from around 62.50 or higher. So that's if the market drops 400 points or stays, or comes back up to where it is, you're making 2% a month. You make 2% a month even if the market drops 400 points. If you're just starting with the 1 put here, and it stays here, goes up. I mean, this is 3 months, and you're making $600 off of 4,000. So that's over 2.5% a month, over 2% a month. Yes. Oh. Oh. Daphne. Oh. So yeah. Like a couple weeks ago, I was looking at the trade that had what 5,500 short puts. I think these were trading for like, we can look at it actually. No? Yes. What were they trading for? That did not work. On Tasty, you can see what the option was trading for. If you right click on it and then hit view the option in chart, you can see on, what day was it? The 14th. It was trading, that was actually the highest point. It was trading for 30. Now it's trading for 10. So at that point, you might want to close them. You can still probably hold that for a little while, but it's getting way out here. 3 delta. You might not want to hold 3 delta short. You have a huge risk of that blowing back up to like 30. But it kind of depends everything that you have on. But you can probably, you just recycle it. You close that, and then you go out to the 90 days or 100 days. You can even use the same strike if you want to. Get back to a 30 credit. So, all right, I'm gonna end the stream now. So we had a couple people popping in earlier, so that's cool. I like to see a couple more views. I'm going to check back in when the market moves a little bit more. I think, like I said earlier, it's probably going to stay in the green cone. It might keep grinding up a little bit, probably about the expected move, but keep grinding up until we see a pop in VIX. So we're going to get a day where it kind of drops down. It might still close inside, but it kind of primes the market for a drop. It's hard to see with these cones on here, but we can kind of look back a little bit, and you'll see this day right here where it drops and then it comes back up. It moves more than the expected move in that day. So volatility might have increased. This day volatility might have increased a little bit. And then the next day, when it drops like this, it definitely increased. And then you get multiple down days. Same thing here. It's grinding up, but then it kind of chops around a little bit. This down day, volatility probably went up a little. And, I mean, you're not going to expect a day like that, but huge down day. Right here, big move. Moved way more than the expected move. closed inside, but it was priming for that next day. Next day, big down day, and then multiple down days. Boom, 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 boom. So even here, this might have been around the expected move and then closed inside, but still sold off the next day. And then sometimes you'll get candles like this. I mean, this volatility had to be super high on this day, but it closed inside. Volatility might have been down. So you might have had a down day in price and also a down day in volatility. That's when you make a lot of money. When you're doing the bear traps, that's the ideal day. Down a little in price and down in volatility, and then you get huge up day. Same thing here. It's probably moved more than the expected move. Still closed inside, but sell off multiple days in a row. And then the rebound, multiple days up, 100, 100, 100. I said we were going to have a couple days, we're going to go up 100 for a couple days, and that's exactly what happened. Here I said we're going to stay inside for a little while, and that's basically what's happening now. And I said we might have 10 up days. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. We might have like a few more up days. We might end up today. It looks like we're going to be an inside day, but it might close green. Might have a couple more green days, and then we're going to turn down again. So let's see. I'll come back on and stream after we get the 10 up days or a big drop. So I'll be back maybe maybe by the end of the week, maybe next week I'll do the next stream, and we'll see where we're at. So yeah, peace. Thanks for being here.